Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report and our weekend show. This weekend show very much focused on the metals sector, M&A, as well as some chart analysis throughout this full hour. Corey Fleck here, along with Shabmar Quitz, your host for this weekend show, also your host throughout the week on our website, podcast, and YouTube channel. Just search the KE Report and listen to all the daily editorials and company updates that we recorded throughout the week. A fairly busy week that we just went through because of the fact of so many companies coming out with news ahead of the conferences in Toronto, especially the PDAC, which is the largest mining conference in the world, and a lot of companies that get news out ahead of that. And we even had big M&A transaction that we are going to discuss at length, as well as dive into what other M&A transactions could look like for investors to analyze. Kicking off the show with Matt Geiger, managing partner at MJG Capital. Matt, as I just promised, let's talk M&A, especially that Equinox-Caliber merger here. Well, I guess it's an acquisition also being called a merger. Really seems to me like Equinox is taking over Caliber, but fact of the matter is this is a company that's going to be, if everything goes through, pretty much major producer, close to 1 million ounce gold producer each year. Combined market cap of the company looking at just under about $8 billion Canadian. Boy, oh boy, there's a lot of chatter from both sides, shareholder-wise, of these companies. A lot of Caliber shareholders saying that they're just simply not happy with this deal. But Matt, let's get your opinion on Equinox taking over Caliber.
Sure, and good to be joining you guys again. I would just say, to start, this is just the latest significant gold-focused M&A deal, really continuing an ongoing trend that I think we'll see last well into 2025 and potentially beyond. I agree with you that market commentary surrounding the deal has been pretty negative. At least in my network, I'd say it's probably a ratio of 3 to 4 voices that are negative on the merger for every one that is positive. And I'd say the share price reaction that we've seen in the aftermath of the deal, which was announced this past Sunday, has kind of mirrored this response. Equinox shares are off roughly 6% from their closing price on Friday. Caliber off close to 9% since the deal was announced, where the GDXJ over that period is down, but only 2.5%. So not catastrophic, but it certainly can't be characterized as a positive, reaction for either company's share. I think what's happening here is fairly obvious. And it's that the Valentine build is probably not going to plan in one form or another. Whether that's a CapEx overrun, whether that's a delay in first production, which has been, slated for mid-2025, whether it's a combination thereof, I'm not sure. But otherwise, why would Caliber be selling the company at a zero premium with just 4 to 5 months before an expected first gold pour? That's a very significant catalyst for any company. And if things were going perfectly to plan, even if the company did ultimately want to sell, the game plan would be complete the build, get first pour, get up to nameplate production, maybe late 2025, early 2026. And then at that point, you can market the company to the highest bidder and hopefully receive a relatively healthy premium. So I think the fact that we've seen this acquisition occur so shortly before first gold pour was expected is showing things aren't going exactly to plan with the build. And to be fair to Equinox, they're no dummies. So I think if there are issues with the Valentine build, they're well aware of it. And I imagine the thought process from the Equinox perspective is probably first, we have a skilled mine build team that was responsible for Canada's latest major gold mine build with Greenstone, which went largely to plan. And so why not get them on a plane straight to Newfoundland so they can repeat the trick, rather than risk losing this talent to other sources. And then secondly, they may be thinking, yes, perhaps Valentine build is not going to plan. However, with the combined balance sheets of the two companies, we should be able to get this done, without a massively dilutive equity raise. which in my opinion, Caliber was probably destined for if they hadn't have done this deal. I think the convertible note that was included within the deal is a sign that they are tighter for cash than maybe they expected at this stage of the build. And then, of course, the secondary rationale is what Ross Beatty trumpeted in the press release announcing the deal. Becoming Canada's second largest gold producer, increased scale, which should help with passive flows as you look at ETFs and what have you. So I think that's the bull case from the Equinox perspective. I will say the downsides from an Equinox perspective include the introduction of Nicaragua, which is yet another country added to the Equinox mix. And I would argue the company was already spread pretty thin over multiple jurisdictions before this deal. They were already in Canada. They're already in the United States. They're already in Mexico. And then, of course, a heavy presence in Brazil. And of course, for Nicaragua specifically, that comes with the policy and jurisdictional uncertainty of the country and whether future changes to U.S. or Canadian policy down the line could cause issues for the combined company. And I'd also say the Equinox shareholder base, has been through a lot over the past few years. And it did sincerely look that the company was in the earlier stages of a re-rate, between Greenstone now coming online, gold seemingly hitting all-time highs every week. And I would argue this will put a pause on any share price momentum, both as the dust settles on the deal and also quite possibly, through the remainder of this build as the market perhaps enters a, wait and see mode to see if they can actually get Valentine up and running, without additional equity dilution. So, that's kind of my view on the state of play. I have no horse in this race one way or another, but I do hope for the sake of the North American gold mining space that this tie-up ultimately works out for both parties.
Well, Matt, I should probably disclose I've got a horse in both races. I've got shares in Equinox and shares in Caliber, and we've had Caliber on the show quite a few times to talk about this deal. But from that standpoint, I think what some of the feedback we've gotten from people sending in questions or just in our comment section is that Caliber has a lot lower cost than Equinox. And while they're introducing an element of risk with Nicaragua, that's actually where their low cost has been coming from, where their exploration success has been coming from, where their new mines have been coming from, in addition to Nevada in the U.S. and now this big Valentine project. They've also been hitting a lot of exploration results that are eye-popping results at Valentine. So a lot of people were expecting to get Valentine into production, but also have the potential for growth with Caliber, and they see that being truncated going into a larger entity, into a major producer now. And from an Equinox standpoint, Ross Beatty mentioned in a recent interview on Kitco that they've been talking about this deal for 7 to 8 months. So long before there would have been a potential challenge at the Valentine gold mine, but there's a desire for Equinox to pay down their debt faster. And one of the things that Ross has championed publicly is really getting on this debt. This brings more debt into the company, actually, but he sees the lower cost operations from Caliber as helping to accelerate the debt payback. Do you think that plays into it all as far as some of the maybe disenfranchised Caliber shareholders, but also the desire for Equinox shareholders to have a faster debt payment mechanism?
Yeah, I mean, we'll see. Yeah, ultimately, it could be off base here, but I would argue from the Caliber perspective, the combination of the convertible included in the deal, the combination of the merger occurring at no premium, and also the fact that it's been effectuated, and pretty shortly before first gold pour was anticipated, signals to me that things aren't going swimmingly. But the cool aspect here is we'll know within 4 or 5 months where things ultimately stand. I mean, from an Equinox perspective, this certainly doesn't help in the immediate term in terms of paying down their debt. But, they clearly have a view that this is an opportunistic acquisition. They're taking another swing here. And, this will probably, if Valentine gets up and running, even if it's a little bit delayed from what expectations are, they can resume their debt pay down plans in 2026. But Equinox clearly thinks that we're in the earlier stages of the gold cycle and that this will ultimately prove accretive to their shareholders.
Just from a market and valuation perspective here, Matt, this merger, as you said, would create Canada's second largest gold producer with a lot of growth coming as well. I was reading over an analysis from Canaccord Genuity recently that was breaking down the price per NAV for this deal, and it was arguing that, look, there is a re-rate potential, but is there opportunity here for investors that want growth to see now a much larger gold producer with near-term growth? Any chance that could bring in some other shareholders?
Perhaps. I mean, passive investing has never been a more significant force than it is today, both within the mining industry and other industries more generally. Though I would just argue I'm not a fan of growth for growth's sake. I think it's important for there to be clear synergies with any acquisition that occurs. And, being generous to Equinox, I think I touched on a couple of the synergies. The first would be the expertise that they have in-house already in terms of very recent mine builds in Canada, and now being able to send those folks off to work their magic in Newfoundland, which is same country, different jurisdiction, but similar style of deposit, similar size of deposit. So there's certainly going to be some overlap there. And then, if I am right that things aren't going perfectly to plan with Valentine, maybe there's some sort of CapEx overrun. Equinox, though, doesn't have a sparkling balance sheet. I think the combined balance sheets of the two companies, as long as the CapEx overrun isn't too extreme, the two companies should be able to get this over the finish line without any draconian equity financing. So I think those would be the two selling points: the skill in-house at Equinox, and then additionally leveraging their balance sheet to mop up any additional funding that will be needed to get Valentine up and running.
Well, Matt, another theme that we can maybe apply to the larger M&A space out of this is two mid-tiers coming together to form a major. There's been a lot of outcry from the industry that there's just not enough majors anymore because they've all cannibalized each other over the last 5 to 7 years and taken some majors off the board. Do you think this is a trend we'll see more of? Because Ross Beatty also made the point that there's a flood of, that this is how he termed it, a flood of institutional investors that just won't touch smaller cap companies, and they wouldn't touch Equinox unless they had a bigger market cap and unless they had more liquidity. And they've got the big board listing where they can attract both the Canadian and U.S. interest in capital. Do you think this is a trend we'll see more of, two mid-tiers pairing up to form a new major?
I think we will see more of that. And I would just say from a broader level, I think precious metal specific M&A is going to be, the theme of 2025. One aspect that's, been touched on by quite a few commentators, but I think it's very important, is the deck has finally been cleared here from Newmont's asset divestitures. And, they've now sold their sixth and final asset. This was last month, the Porcupine Complex being sold to Discovery Silver. I would argue that the whole sales process, which was, roughly a year-long process for Newmont, definitely had a dampening effect on other gold and silver M&A. While we did see plenty of other deals, I would argue that, without the Newmont process, we would have seen even more. And that's because for each of these, 6 asset sales, there were 20, 30, 40 groups in the data room for each and every one of those deals. And even for these larger companies, like the teams that are conducting M&A and due diligence are constrained in how many deals they can look at any given time. So now all these groups are able to free up their manpower to look at other mergers and acquisitions. And this could be, as you mentioned, between two mid-tiers trying to get towards that, $10 billion line in the sand in terms of market cap. I'd also say another, tailwind for gold is the fact that gold is currently one of the few metals that currently is not being bucketed into the broader, critical minerals theme. And just in the past year, we've seen plenty of Chinese activity. Zijin has been particularly active, buying Akium from Newmont, Rosabel from IAMGOLD a little further back, La Arena from Pan American. More recently, we saw Shenzhen International buy Osino Resources Twin Hills project. That deal closed in Q3 of last year. So gold is really one of the few metals where, Western developers can reasonably look to Chinese entities as a potential exit point. And, I also find it interesting that the Lundin family have really teamed up with Zijin on a couple different strategic investments. So not quite M&A, but maybe headed down that track. First with Montage Gold last year, and then more recently last month with Predictive and their Bankan gold project in Guinea. And I would argue, all else held equal, that if these assets were copper or nickel or any other, name your critical mineral, that these two groups would not be working together in terms of the strategic investment. So I think it remains game on, specifically for gold and precious metal focused M&A in 2025.
Man, we've seen so much M&A just over the last kind of year and a half, and it seems like it is continuing. So Matt, what do you look for when you're analyzing some of these deals on the back end? If you're not a shareholder of, let's say, one or even both of the companies that enter into an M&A deal, we do typically, it seems like, see stocks sell off on the back of that announcement and on the acquirer's side. But how do you go about analyzing if these deals make sense? What are some of your key points that you focus on?
Yeah. So as a first principle, I would argue that 70 to 80% of deals ultimately prove value destructive from the standpoint of the acquirer. So I would argue that the onus is on the acquirer ultimately. And historically, and there have been, many studies done, both for mining specifically and also across other industries, that show that more often than not, it's actually the seller that gets the better of the deal. So I think the onus is on the acquirer. I ask myself, basically, I have a list of 9 questions that I'll go through when I see a new deal and I'm trying to determine, does this or does this not make sense from the acquirer's perspective? So running through this quickly, first question are there operational synergies between the project or projects in question? Second would be, are the asset or assets being acquired in a region, or better still, in a district that management of the acquirer has deep experience and deep familiarity with? Third would be, do the projects being acquired share the same time zone with the company's existing assets? Fourth would be, in a similar vein, does the project or do the projects being acquired, are they located near the company's headquarters? And better still, the homes of key members of management and board. Another one is the deposit type or the project characteristics similar to what the acquirer is working on already. So the similar type of mineralization, what type of mining method? Are we talking underground or open pit? These are both relevant. Also worth asking, does the target commodity make coherent sense with what the acquirer is producing or working on already? Another thing to consider is, does the acquirer have the financial capacity to materially advance the acquired project? And then the final 2 would be, is it a related party transaction? And then, of course, not least, is the price fair?
Well, Matt, that's an impressive list and a lot of things for investors to consider when they see these M&A transactions deal. I want to go back to what you said at the onset, as a first principle, that most of these tend to, I guess, 2/3 of them favor the asset being acquired over the acquirer. And when you think about the outpouring of emotions we see after some of these deals in chat rooms and forums and on conference calls and Q&A sessions, it seems like the people that get acquired are always upset. The investors feel like, they got grabbed before they had a chance to shine. And when you think about even some of the recent deals we've seen, like when Gatos was acquired by First Majestic or when Silvercrest was acquired by Core Mining, a lot of investors said, you just stole our future. We were going to ramp up with the silver price, and now it's going to be buried in a larger entity. And there's times where companies do overpay and they find out afterwards they bought a lemon, but there's a lot of times where they're grabbing a lot of value at a low point. And we've been joking on the show for the last 2 years that a lot of these deals at a really low premium or at a 52-week low were take unders, not takeovers. So maybe unpack that idea a little bit more.
Sure. I think there's a couple factors at play. So there are certainly deals that make a lot of sense. And I guess 2 that come to mind, I guess I'd call them the poster children of quality deals from the past couple of years. Probably the biggest one is Alamos's Gold's takeover of Argonaut and its Magino mine last year. This just made so much sense between the shared infrastructure between the 2 assets, increased combined mine life, increased production profile, the fact that Alamos could leverage Magino's excess tailings capacity and avoid having to permit and build additional tailings capacity at Island Gold Mine. Like, it all made sense. Familiarity with management with the district, same target commodity, similar deposit styles. So from my perspective, that's one deal that checked all the boxes. Another one would be Lundin Mining's acquisition of Caserones. This was back in 2023. You're talking about the Lundin Group, which has deep experience in Chile, and particularly within the Vicuña district. You're talking about a company or an asset that has operational synergies with Lundin's Candelaria mine, which is only 150 kilometers away, which in that part of the world is just a stone's throw away. You're talking about a company with a balance sheet that could give, Caserones the TLC that it deserved and wasn't receiving under its previous owners. And then, of course, the target commodity made sense as well. So those are 2 examples of deals that I think are shining instances of M&A that made great sense. In terms of, disappointed shareholders in the aftermath of deals, particularly for the company that's being acquired, I would argue in many of those cases, we're seeing a classic cognitive bias in action, and that's the endowment effect. Anything that we own or, hold on our own, we place a higher value on than others or third parties that are out there. And so, just looking back to the Caliber Equinox deal and the Caliber shareholders that are disappointed, it's going to take some time for the dust to settle, whether that's 6 months, a year, 2 years. I think it's too early to make it a definitive determination one way or another. But if, 3 months from now, we see that Equinox or the combined company announces that, Valentine's first production date has been pushed off by 3 or 6 months, that there's a, 20 or 30% overrun in the ultimate CapEx for the project, like, it could be a very different calculus. So I can understand the immediate frustration in the case of this deal, the fact that there was no premium at all. But, one has to wonder whether that initial visceral reaction will ultimately be warranted looking back on this deal with hindsight.
I always find it funny. Investors always complain about M&A, even if it's at all-time highs for companies. So it's one of those things that sometimes I feel like we just need to understand that people, yes, they love the stocks that they hold and they want them to keep running, but M&A is good for the sector. And Matt, one other thing that I want to touch on here that you said, you're not very enthused about M&A for growth's sake, just to grow. But if we take a step back, we do need to understand where the gold price is right now. And if you can take over a producing asset, that's where we've seen a lot of M&A, then you immediately benefit from these higher metals prices. It's actually one thing that I've been thinking about a lot is that, yes, I know we don't want these majors to grow just for the sake of growth, but the one thing that's been standing out to me in terms of the financial results recently is the lack of production growth from these companies. Why not increase your costs maybe 10, 20% if you're bringing on that much more production so you can take advantage of current metals prices? What would your argument be to that strategy?
Well, it's a fair point. I mean, in a rising metal price environment, it actually behooves a producer to have a higher cost of production. You get better leverage to additional increases in the metal price, and bigger is better. So that can work. And, if we're in the early stages of a gold bull market that's going to last for 4 or 5 years from now, if one could look into their crystal ball and determine that, then a lot of these deals just to get bigger for, growth's sake can make sense. The concern I have as an investor that, cares for the long term of the space is that we repeat the mistakes of previous cycles. And I don't think we're seeing deals that indicate that we're in that phase of this bull market, not by any means. But, think back to the Chinese-driven super cycle, and one can take this kind of viewpoint to its logical extreme. And that's where you're buying, large, low-grade, high CapEx deposits that make sense on paper. And sure, if metal prices rise in perpetuity, it's going to make a lot of sense. And then you buy those deals, using significant amounts of debt. Of course, that did not work out very well, particularly amongst the gold producers. And I would argue some of the sins of the past cycle are large part explain why this sector remains so out of favor. Even with gold prices bumping along all-time highs as we speak, the disparity between the miners and the actual metal prices has never been larger, at least certainly during my lifetime. So I would prefer for the industry to avoid that fate again. But, who knows, when animal spirits really get going, human behavior seems to occur in cycles.
Yeah, Matt, I hope we all don't see the kind of situation we saw in 2010 and 2011 at the very end of that life cycle, where a lot of CEOs lost their jobs just for growing for the sake of growth. Hopefully it's smart growth. Just another angle on this, that there has been an area of the M&A in the gold and silver space that has been getting traction with investors, and that is actually juniors buying producing assets, sometimes in metals that they don't have experience in. So if you think about Discovery Silver buying the Porcupine complex from Newmont that you brought up, that's a silver developer that was considered an optionality play, buying producing gold mines and development gold mines in a totally different metal and in a different, area than they're used to. So it was very well received by the marketplace. And we've seen a handful of other companies, Matt, do the same thing. Heliostar buying a couple Mexican mines from that Argonaut, from the ashes of that Magino deal that you talked about with Alamos, or Integra buying the Florida Canyon mine also from that Argonaut spinout from the Florida Canyon Gold. We've seen Magna Mining go into production in copper by buying up some mines in Sudbury. And we also saw Sierra Madre Gold and Silver as a junior explorer buy a producing mine, or a mine that has produced recently, La Guitarra, from First Majestic. There's 5 juniors that all became producers, and they were rewarded by shareholders, and their stock price did well. Is that a trend that we're going to keep seeing, juniors that decide to become producers?
I think it's likely. I mean, a part of that was due to asset divestitures. So we saw Alamos Gold sell off their non-core assets that, provided a lane for juniors to step up and pay a pretty penny to take those assets on. No more sales from Alamos expected. Newmont sales process is wrapped up. Equinox, I should note, hinted in the news release announcing the deal with Caliber that they maybe would embark on a sale of a couple of their non-core assets. So I'm sure plenty of juniors will be looking at those and maybe replicate the blueprint that we've seen with some of these other companies. I mean, I think you hit on all the big ones. Probably the most surprising reaction that I saw was the Porcupine complex being acquired by Discovery Silver. I was clearly wrong on this, but my view was that most investors in Discovery Silver were in it for the silver optionality. The fact that Cordero being such a large deposit, relatively low grade, like the numbers start getting stupid if you plug in $40 or $50 silver there. So I would have expected a more negative reaction to that, just that the company's diluting its exposure to that asset ultimately. Though perhaps Tony Makuch's deep experience within the Timmins area helped kind of nurse shareholders along and get them excited about that deal ultimately. I will note that there's about $1 billion in reclamation liabilities that will, basically have been incurred here by Discovery Silver. But, that's a bit further down the line. So I think the market has so far overlooked some of the negative aspects of that deal and have gotten excited about Discovery now being a producer. And if all goes to plan, they won't have to dilute as they push their Cordero project in Mexico forward, pending permitting, of course.
So let's look forward then, Matt. Where do you see this M&A ball moving? What companies are in play? What stage of companies? What type of assets could be next on the chopping block, or at least it would be taken over throughout this year?
Yeah, so I touched on, I think the theme will remain precious metal focused M&A, plain and simple. In terms of business model, this is something that I've mentioned on this program as well, but I'll continue banging the drum. I do see M&A occurring amongst the royalty and streaming juniors. There's at least 6 groups out there, and we're talking, Gold Royalty Corp, we're talking Metalla, Elemental, Vox Royalty, EMX, Ecora, all in the similar snack bracket. We'll say 150 to 450 million market cap. And I think there's a huge opportunity for 2 or maybe even 3 of these groups to come together into a single entity, join forces, and get their combined market cap, closer to that magic $1 billion number where liquidity increases and larger institutions begin to take notice as a result of the scale. So I think this would be hugely beneficial for the junior royalty and streaming space, because right now there's a lot of competition, both for deals, but also access to capital and vying for investors' attention. So frankly, I've been surprised that we haven't seen more activity here. We did see Trident taken off the board in the spring of 2024 when Doterra came in and took them out. I think that was roughly $180 million US acquisition. But I think there's clear opportunity here. Ultimately, it's about management teams putting their ego aside and agreeing on a price. But I do think we see some movement on the junior royalty and streaming space in 2025. Just to, I'll throw from a jurisdictional perspective, I'll throw Brazil's hat into the ring. I think the country has done a pretty good job. This may change as we come into the Trump administration here, but Brazil has done a pretty good job of walking the tightrope and remaining hospitable, both to the Chinese and the Western world in terms of foreign direct investment. And there's quite a bit of activity going in country at the moment. We have BHP, who's running an asset sale on its copper projects in the Carajás. These are assets that were ultimately acquired in their Oz Minerals acquisition back a few years. These are high quality assets. I think there's a lot of opportunity there for acquirers, but they're just not of the scale for BHP, the world's largest mining company. So that process is ongoing. I think we will likely see, 1 or more of these projects go, probably by Q3 of this year. Another example, name that I've talked about on this program, Lara Exploration, which is an MJG partnership holding, one of our largest holdings, in fact. They've been quite clear that their flagship Plan Alto project, which is also in the Carajás mining district, is on the selling block if the right price emerges there. So that's another asset that could go. I should note La Mancha's recent foray into Belo Sun mining and its Volta Grande project in Brazil's Para state. Whether this is a precursor for G mining, because of course La Mancha is a major and influential shareholder of G mining, whether this is a precursor for G Mining coming in and taking that project on, or just a strategic investment for La Mancha remains to be seen. But I see a lot of activity in Brazil, so I think the number of deals there in 2025 might catch some market participants off guard.
Well, Matt, one other area to weave into the M&A discussion is if we even move further down the food chain into the juniors. There's been another trend, I'd love you to get you to weigh in on it, where we've seen two development companies merge together to form a larger company that now has two development assets. Just two companies that come to mind quickly are what we saw with Stellar, where you saw Moneta and you saw Nighthawk come together. And then we also saw that with Next Gold, where you've seen Treasury and Black Wolf Copper originally form into Next Gold, and then also bring Signal Gold into the equation now, where they have 3 million ounce deposits. Now they got 6 million ounces. But in both companies, they still have the same issue that they had as single companies, the access to capital, getting one of the two built, et cetera. How do you look at those kind of mergers where you see two juniors massing up into a bigger junior?
Yeah, I really would look at it through a similar framework of what we touched on earlier. And in the case of both of those deals, I think it's hard to say that there are legitimate operational synergies between the projects in question. There is an argument in favor of, spreading out G&A out over multiple assets. And, in the case of Stellar, there are some similarities between the projects in terms of the target commodity, the scale of the projects. But I think part of the reason the market didn't really latch on to either of those deals, or at least haven't yet, is just the combination of the two assets doesn't make a huge amount of sense. But again, I think we'll probably see a lot of M&A in a very general sense. Like, the more activity, the better. Like, there are plenty of juniors out there, and it would behoove us as investors for there to be less and less opportunities. Of course, ironically, as bull markets progress, the exact opposite happens. Companies spin out assets into new companies. There are new IPOs. There are new companies that are formed via RTO. So anytime that you can take a few companies off the board in a very abstract sense, I think that's good for us as investors. But again, I want to see deals that make sense. I want to see deals that have operational synergies. I want to see deals where the management team taking over the combined company has something to add to each and every one of the assets in the portfolio. I think that behooves us as an industry over the longer term to try to stay as disciplined as possible from an M&A perspective.
All right, Matt, we're wrapping it up here. Look, I want more M&A, to be honest with you. Bring it on. Let's see so much more M&A that it frees up all this capital. But I totally get what you're saying. Let's build some quality, long-lasting companies. But hey, look, I want some growth. I want to see companies take advantage of these higher metals prices. Not saying it'll work out long-term, but I do think that could bring in some other type of investors. Hey, Matt, always great chatting with you. Always so insightful to hear what you're looking at and your thoughts on the resource market. Again, Matt Geiger, managing partner at MJG Capital. Click that link in the show notes to learn more about Matt and his metals fund. Everyone, stick around. We're going to be right back with more technical analysis of the precious metals.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, we're bringing back on Richard Postma, also known as Doc. Been a few months since we last had Doc on the show, and very happy to get his more technical outlook for the metals, individual metal stocks that Doc is accumulating and trading, as well as move into some of the other markets out there, the bond market specifically, and also U.S. equity markets. So, Doc, without further ado, let's get right into the gold market. Gold has been knocking on the door of $3,000 an ounce. Little bit of weakness this week, but again, overall, we continue to talk about just how strong this gold price is, and it seems like any sell-offs are pretty quickly bought back, and any dips are relatively shallow. So, Doc, in terms of the chart, what are you seeing? Are we in for another up leg here, or could gold level out for a little bit longer?
I think we're topping out here, Corey, for a while. And it wouldn't surprise me if we almost for sure the next couple of months are not going to be that kind to gold. And then after a couple of months, I can probably tell technically whether it's going to endure longer than just 2 months or whether then we're going to have a rebound go higher.
Well, Doc, when you look at the charts, a lot of times you're looking at longer term charts, the weekly, the monthly. Any indications you see technically in the charts that lead you to that impression?
Yeah, because usually I look at the monthly a lot, but right now I think the key chart to watch is the daily, actually. And the daily shows that your 12-day moving average has taken out the 26-day moving average and is starting to trend lower. And so I think the odds are good that we're heading down to 28.50 on this current move. And then we might get a little rebound, but then we may head even a little bit lower going into March and April.
Doc, if we look back in history, look, it's very rare actually that we've seen gold in overbought territory on the daily, weekly, and monthly charts, and that's where we're at right now. Looking at a 25-year chart of gold, the only other times that I see gold in an overbought monthly chart is back in 2006, 2008, and then 2020. It was briefly there also in 2011, but looking at history and also just looking at this chart, pretty much how vertical the gold price has gone in the last year or two. What do you compare this to in terms of history and the gold price move that we have seen in the last about year to two, but then also going back to really 2015? It's been 10 years and gold is up 3x pretty much.
Yeah, and you don't see anything like that. You could probably go back to the late 1970s and into 1980, where you see a chart like this, but it's really unusual, the magnitude of this move. And if one would look at the MACD on the monthly chart, one could say, gee, we're going even further because it looks that strong. But the daily is sending off some warning signs right now, and so is the weekly chart. And generally, I stick with the monthly until it tells me I'm wrong. But I think the daily is starting to warn people now that we've reached a level where it's going to be hard to take out 3,000 with any vigorous action. Now, we could move a little higher yet next week and so forth, but there's warning signs that we've topped out here for a while. But that necessarily isn't bad because people think, well, this bull market is over. But no, I think we're still in a long-term bull market. But you're going to have some pullbacks, and that's healthy. And I think we're about to see one here. And it's just a matter of what the magnitude is going to be. But time will tell. I'll be able to forecast that a little bit better after we get a couple more months under our belt.
Well, the action usually starts on the daily first anyways, and then it translates over to the weekly and monthly. But to the point you just made about it being a long-term bull market, a lot of people will look at this correction and wonder, are we going to see the same thing at $3,000 gold, the inability to attain it, that we did at $2,000 gold? If you remember back in 2011, everybody was just sure we were going to make it to $2,000 and beyond, and it stopped at 1921, 1923. Do you think that there's any risk of that happening where we just never make it to 3,000, or the comment you just made about it being a longer term bull, do you expect still much higher prices?
Yeah, I do expect more higher prices, but we could go the whole year and trend down, and I'd still feel that we're in a long-term bull market because the manic stocks haven't shared in this bull market yet. And before it's over, you're going to see the mania with the juniors happen. And we haven't even seen that. But it's like I said 3 years ago or 4 years ago when I told people we'd probably topped in 2020. And a lot of them were so bullish yet. And we traded off. And I told them to expect that we were reaching a top and we were going to trade sideways to down for quite a bit of time. And we did for almost 2 or 3 years. And you could see that again here, but I don't think so. I think what we're going to see is we're going to see that gold and silver will go into a little bit of hibernation for a while. They're overbought and they could move out of overbought territory, but then they could move right back into it which often happens in a strong market. And that's what I'm kind of curious to see as we go forward, whether we move out of overbought territory and then we elevate back into it and just do one of those things over the next number of months as we go forward. And that would really show me a strong market. And you could stay there for quite a while, frankly. And then ultimately, if that happens, you're going to get your mania phase in the juniors.
Yeah, eventually. But hey, here and now, look, we've been saying that this is a very good market for a wide range of companies. And as much as everybody's hoping for these juniors to catch a bid across the board, to me, that's more end of cycle type of move. So we haven't seen that yet. And to your point about being in overbought territory, that signifies a bull market. So yes, the longer it can stay around and at overbought levels, that's always positive. But Doc, you brought up silver. And look, let's be honest, the silver chart has not been as strong as the gold chart. Broadly, silver has lagged gold. Yes, it's broken out to multi-year highs, but it's still a long way away from all-time highs, and it hasn't provided that sort of leverage that gold has in terms of simply price moves here on a percentage basis, even really on a dollar basis. Doc, what's going on with silver here? What's holding silver back?
I think what's holding silver back is silver may be anticipating a recession here and a decrease in demand. We all talk about a supply deficit that's been there for a number of years now. And I think that's what's really holding silver back. But even if we have a recession, I think you're still going to see a supply issue, although there's some mines that are really producing quite a bit of silver right now. But I think a longer term, we're still going to have a problem with the supply issue. And if we get stimulus again, because we move into a deep recession, I think silver is just going to be fine, because on a long-term chart yet, even though we're going to move down here a little bit, I don't think the long-term charts are at risk right now. We could move off a top here, and I think we will for a while, and we'll just have to see how deep the move is down. But I think we've topped out in silver for a while too.
Well, Doc, what does that portend to the precious metals equities? Because they tend to track silver more so than they do gold. And I guess in this answer, when you look at the stocks, are you looking at things like the GDX and GDXJ as far as the ETFs, or are you looking at the different story that a lot of individual stocks have on their charts compared to the GDX or GDXJ?
I look at both, and frankly, I'm not too concerned about the GDXJ and GDX right now when I look at them, because I think actually, as we get a pullback in gold and silver, I think the GDXJ and GDX aren't going to be impacted that much this time coming around, because, the price is just relative. I mean, some of these companies are spitting out cash flow like crazy. And even if you drop gold $100 to $200 to $300 and silver maybe $3 or $4, I don't think it's going to impact these stocks that much going forward this time. And so I think GDX, GXJ are fine. And in fact, on this pullback, I'm really excited about it. And I hope it stays with us a little while longer, because it just gives you more of an opportunity to pick up some of these companies again at depressed prices. So I think it's an opportunity. I don't have a problem with gold and silver selling off a little bit. I look at it as positive.
Doc, a little bit more insights on that GDX chart, though, because look, there was the pretty much 3 months of weakness to end the year, and then a very strong rebound, pretty close to right back to the highs of last year, which again were multi-year highs. However, we're just seeing pathetic volume and stuff like GDX. So how do you balance out exactly what you're seeing on these charts, and what sort of levels could we see on something like the GDX chart if it is starting to roll over again?
Well, what's interesting on the GDX monthly right now, if we end where we are currently, the month, which is only 2 days from now, which I think will happen, we're closing at a monthly high that we haven't seen in 5 years. We're going to close over the monthly high in 2020, which is very positive. Now, I think we'll pull off of it for a while because it's just a good test. But in GDX, we could move back down to 35 and I wouldn't even be bothered by it. and we're currently at 40.96. So I don't consider that a big decline, actually. And we'd still be in a bullish mode, and we're at 40, almost 41 right now. So we can move down in that, and I don't think we're going to go much lower than that at all. So the bull market would be still intact for GDX. And also, I like the way the chart looks in GDXJ. And in fact, if you look at the MACD, the monthly MACD on GDX right now, it still looks very healthy, and it would have to start rolling over. But even the ADX, the strength indicator, looks fine. So I don't see the GDXJ and GDX impacted that much from gold and silver moving down a little bit here.
Well, Doc, like we were talking about off mic, a lot of the charts of individual gold or silver stocks are actually doing a lot better than the GDX or GDXJ. There's some laggards inside of those ETFs that kind of drag them down. But when you look at individual stocks in your own portfolio or ones that you're tracking, any of them jump out to you? Any charts you want to discuss?
Yeah, I like, and I just added a little bit more to it yesterday. I like Core. That's one of the companies I really like going forward. It's spitting out cash like crazy, and they got some good projects, and management is decent. And I just love the chart because on the monthly chart, the 200-month moving average is working down toward the pricing nicely. And once it gets close to it, I think eventually Core is going to take it out. It's not going to happen, I don't think, this year, but it will eventually do that. So I like Core. I like Equinox, especially now with their merger that they accomplished this past week, which is supposed to close in 2 to 3 months with Caliber. And Equinox shareholders came out of that pretty good because there was no premium for Caliber on that. And of course, their shareholders probably aren't happy. But I also like the fact that Equinox peaked its head over a new high this past month, and it's coming off of that. And that tells me that stock's ready to move up in the next phase. And then another company I bought heavily into when it was very low was America's Gold and Silver. And now they got new management, which I really respect. So those are three that I particularly like right now and that I have pretty strong positions in.
Doc, one thing that stands out to me with all of these is that these are not really anywhere near all-time highs. From what I'm seeing, these stocks, in a way, have lagged a large amount of other companies that have been breaking out and continuing to break out. So is that more the theme for you now, looking at these other companies that, yes, they're off their lows, but nowhere near all-time highs?
Absolutely. And I like to buy companies where I like the story also. And I like the stories of these. For instance, Equinox is going to be paying down debt like crazy the next 2-3 years.
Well,
and I like that.
They just took on more debt.
Yeah, and they got a ton of debt already. So, and as they expand production going forward, if they don't have any major mess ups, like so many mining companies can, I think Equinox is really a good value here. And so I go with the fact that these companies really haven't benefited at all, and they can easily double and more. And based on the stories too, that's what I really focus on, and management. And so those are just three of the stocks I hold, but I'm particularly going to purchase more when they move, down. Another one I like a lot, but I don't see moving higher real quickly until, the future, is I like Integra a lot. I like the management there. I like how they manage that company, and I got a good position in that. It's going to take them a while to really get to move, but they will in the manic phase of this bull market, which is coming down the road. And so that's another one I particularly like.
Well, Doc, and all of those examples, Integra, Core, Equinox, and America's Gold and Silver, they're all producing companies. A lot of people listening in aren't really positioned in some of the producers. They're more leaning towards the pre-revenue juniors, either the developers, the explorers. Any stocks in those areas that trip your trigger?
Some of the ones that get people all excited, and I don't do too many, but things like Newfound Gold, for instance, I think they bottomed out, so I like them. particularly. And there's others that I do too, but I try to stay with mid tiers that have even more promise. I don't do a lot in the ones that have just found things, but where there's just hope included. Because one thing I really believe in is the Lassonde curve, where you find a promising development and the stock just takes off. And everybody gets excited, they pile in, and then they get just hammered when reality sets in and the price drops back. And then the next part of the Lassonde curve is when they actually develop the mine. And that's the next time the stock runs. So that's why I kind of stay out of some of these, because it's just hope, a lot of it. And I don't like to lose money.
Fair enough, Doc. What about those optionality plays? What about all these companies that have resources in the ground that, look, gold ounces in the ground were being valued at $5 to $10 not that long ago, a few years ago. Now they're up to $10, $15, $20, $30. We've even seen some takeovers at much higher prices for ounces in the ground. Are you playing any of these, let's say, advanced explorers or so-called development companies that, quite frankly, are just sitting there with assets with ounces in the ground?
Not really, except, one of them, of course, is Equinox. They have a tremendous number of ounces in the ground, and they have promise of exploration and finding more because they got land package, which is good. But otherwise, not really. And the other ones I look forward is that have significant ounces. Don't give me a company with just 1 million ounces, because I like it when they find a really good promising aspect of indicative and where they have, significant ounces. Those are the companies I look at. I don't look at the ones that really don't have many ounces and are unlikely to be takeovers based on that.
Yeah, you're making a great point, Doc, because there are a ton of companies now that seem to have 1 million ounces, but there's not many that have 3, 4, 5, 6, 7 million ounces and above. So you're kind of filtering for the larger projects. Are there any other resource stocks outside of gold and silver that have your attention? If you look at energy, or if you look at, oil and gas, or uranium or copper, anything else that you like outside of the precious metals?
Yeah, I'm starting to finally get into uranium again. I had been in it, and it took its big run, and then everybody got real hyped about it again. I'm starting to dip my toe in uranium, and I'm starting to dip my toe into some energy stocks. And I'm going to do it very gradually, because I don't think we're going to see any significant run in those for a while yet. And so I'll cost average down a little bit until they hit bottom, and then I'll take a larger position in some of these.
All right, Doc, let's talk markets then. I know you wanted to talk about the bond market, where rates have been, I guess, kind of bouncing sideways here. They're definitely not going down anymore, but we're also not seeing huge spikes in interest rates, as we're talking the 10-year right around 4.2%, which again is a little off some of its highs from earlier this year, but pretty much right in the middle of this range that we've been in since Q4 of 2023. What do you see happening in the bond market?
Interesting. What the long-term charts are telling me in the bond market right now, we're getting a little rally in the bond market, but based on what I'm looking at from a long chart basis on the monthly, to me, there's very good odds that toward the end of this year and into the first half of 2026, we could see the second leg of the bond market down. That means higher rates. So one has to ask themselves, well, how could that happen? And that tells me that inflation, which is moribund right now, is not dead. And something's going to give. Now, that could change. I could change my view on that if I see some things technically. But right now, it's showing that there's going to be pressure on the bond market end of this year or the first half of next year. And so I'm keeping my eye on that to see what's going to happen there. I think we're still going to move a little higher next month in the bond market, but then I think it's going to come back a little bit. But watch out toward the end of this year or first half of next year for the second leg down in the bond market. The first leg ended in the end of 2022, and we're going to see a second leg down. It's just a matter of when, and I think it's coming.
Well, Doc, you're not alone in that view. A lot of people think after a 40-year bond bull market that we need to see a more protracted, drawn-out bond bear market. But I guess I got to wonder, what are the higher rates that it would be in store with the bond sell-off? So, this is not next week or next month, but, towards the end of this year, beginning of next year, if we do see the bonds start selling off even more, what does that mean for the Fed? Do they come in and try to backstop it? If rates start going higher, do they abandon their idea of cutting rates and go into hiking rates? How does that affect, the precious metals, the markets? What's your longer term outlook on a bond sell-off and higher interest rate environment?
That's going to be a hard thing for the Fed. They're really in trouble because the second biggest expense of our budget now is interest payments on the bond market. So they're going to have to solve a way of somehow keeping the interest rate down on these bonds, or some other methodology to the damage it would do to the budget. Now, they're doing a couple of things right now. Of course, you got Musk doing his thing from a cost standpoint on the budget. And then if there's increased tariffs, that's going to bring in revenue right to the government. So that's going to be a positive. But other than that, they're going to have to get creative to find a way to prevent the damage that higher rates would do to the government budget. And I've seen a number of thoughts on how to do that, but it's going to be interesting to see what the Fed does and what the government does to prevent a real meltdown and collapse of our government from that standpoint.
Is this a this year type of problem then, with higher rates starting to creep into at least people's radar or actually into their back pocket?
I think it's going to be more next year. And I think we're going to get a little relief here for a while, but based on what I'm seeing technically, it's going to happen next year. But we'll see. And if I come on in the future, I'll remark if I see a change in those charts that tell me, hey, we're going to get a reprieve from that. But right now, it does not look promising.
Well, Doc, let's quickly fit in the general markets. When you look at U.S. equities, they've had a rip-roaring couple of years here. You've actually done well trading some stocks in the general equities, but are you worried we're getting up to a point where the rally is over? Is there an extension of this rally? How are you looking at U.S. stocks?
So U.S. stocks are going to come off here for a while. I wouldn't be surprised to see us go down to about 42,000 in this move down. And I think we're going to get that. And then the question is, do we break lower? Do we break the uptrend? And we're going to know, frankly, and probably by May, whether we see a break lower. And it's very possible we could go then down to 35,000, 37,500, that area. But what's interesting to me also is another chart, which is the Dow to gold ratio. I think that's a chart that people should be watching too now, because we're right at an inflection point on the Dow to gold ratio. When you look at the monthly chart, we're sitting right at the 200-month moving average. And we're looking like we could break below that in the next 3 months. And if that's true, that means a combination that means that the industrials are going to underperform gold. And so that tells me that the stock market could continue to get hit while gold could maintain its pricing pretty well. So I would encourage people to keep an eye on the monthly chart on the Dow to gold ratio, which looks like it wants to break lower.
Well, that's something definitely to watch. And in all fairness, looks like gold has been outperforming the Dow since the start of 2022. Really outperformed in 2020 for a short period of time. But other than that, this chart has been relatively range bound for about 10 years now. Looks like any break below kind of a 12 level, 12 and a half, would really signify a major move here. But you're not the only one to bring up that relationship, and I know it's something we're talking about regularly, is how gold is reacting and how it's faring against the conventional markets, which, boy, oh boy, those U.S. markets have done well for so long. Doc, we'll wrap it up here. It's always great having you on the show. Thanks for taking time with us on this weekend show. And for all of you listening, please check out the rest of our show throughout the week, either on our website, kereport.com, on our podcast. Just search The KE Report in your podcast player, or on YouTube, again, by searching The KE Report. Please subscribe, leave us a review and a rating. It helps move us up those charts. Doc, again, thanks for joining us on this weekend show. Everyone, thanks for tuning in to the weekend edition of the KE Report. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.